Welcome to the Deep Dive. Today, we're taking a close look at Standard Chartered's half-year 2025 results.
That's right.
And this wasn't just another earnings call. It really painted a picture of strong financial performance and a very clear strategic direction, too.
Absolutely. We'll break down those crucial figures, identify what truly drove their income growth,
Yeah.
and explore how the bank is strategically positioning itself, especially in those rapidly evolving worlds of digital assets and sustainable finance.
Definitely areas to watch.
It's a deep dive that offers a lot of clarity on their path forward, I think.
Okay, so let's jump right into the big picture then. Standard Chartered delivered a genuinely robust first half of 2025. They significantly beat market expectations. For you, this means their underlying earnings per share, or EPS, soared an impressive 41% year-on-year. That's up to 139.2 cents.
Wow, 41%.
Yeah, and the reported EPS wasn't far behind either, up 55% to 129.1 cents. This isn't just like a good quarter.
Yeah.
It signals a powerful turnaround in profitability and a strong trajectory for shareholder returns.
A standout point here, for me anyway, is the operating income. It reached $10.9 billion.
Okay.
That's a 9% year-on-year increase. Actually, 10% when we adjust for currency fluctuation.
Right, constant currency.
And their underlying profit before tax, the PBT, hit $4.68 billion. That's up 18% at constant currency, blowing past the Refinitiv consensus by pretty significant $0.55 billion.
Okay, so not just meeting, but beating expectations there.
Exactly. These aren't just numbers. They really tell a story of a company hitting its stride.
And focusing on the second quarter alone, income reached $5.5 billion. Underlying PBT came in strong at $2.4 billion. That's a solid 34% increase.
34% just in Q2.
Yeah. And what really caught our eye was a return on tangible equity, or ROTE, of 19.7% in Q2.
Almost 20%. That's excellent.
It really is. Plus, they announced a new $1.3 billion share buyback
Another one.
and boosted their interim dividend per share, DPS, by 37% year-on-year to 12.3 cents.
Yeah.
That's a confident move, isn't it?
Yeah, it truly is. This kind of performance, especially with some, market headwinds out there,
Right?
it prompts a key question. How did they manage such impressive results? Their Common Equity Tier 1 ratio, the CET1, also stood at a healthy 14.3%.
Solid capital.
Yeah, it rose about 50 to 60 basis points quarter on quarter before factoring in that buyback. It signals a very solid capital position, gives them flexibility.
Now, let's explore how this strong income growth, particularly in Q2, actually happened. It seems it was largely fueled by non-net interest income,
Yeah.
often called non-NII, which surged 31% year-on-year. This is a critical distinction, isn't it?
Yeah.
It shows diversified revenue stream.
Absolutely critical. And digging deeper, this non-NII growth was incredibly broad-based, which is, a very healthy sign.
Okay, so not just one area.
No, not at all. Their global markets segment saw a 28% increase in the first half. Wealth Solutions was up 24%, and global banking grew 14%.
That's pretty widespread.
It is. And even if we exclude a notable $238 million gain from a specific transaction in India, the Solve India deal, their non-NII was still up a remarkable 22%. This tells us the growth engine is really multifaceted. It's not reliant on just one single area.
Okay, that's the non-NII side. But interestingly, net interest income, or NII, that remained flat in Q2 at constant currency.
Flat, yeah.
And actually saw a 4% dip quarter on quarter. Management attributed this to a sharp drop in HIBOR.
The Hong Kong interbank offered rate?
Exactly, Hong Kong's key interbank lending rate. Plus, lower rates in Singapore and India also limited their ability to easily pass through rate changes to customers.
Right. So basically, the cost of borrowing for their clients in those key regions declined, which squeezed their net interest earnings a bit.
Makes sense.
And this brings us to a crucial point about the NII outlook. The company now expects their 2025 NII to be down by a low single-digit percentage year on year.
Okay, so they've adjusted guidance downwards there.
They have. However, management expressed confidence that this guidance holds even if HIBOR rates stay where they are right now.
Oh, interesting.
Yeah, they highlighted the HKMA's aggregate balance reductions, and they anticipate an easing of NII pressure in 2026 based on forward rate curves. So while there's a near-term dip, they seem to see light ahead.
So while navigating these interest rate dynamics, the bank wasn't just reacting passively. They're actively shaping their future through disciplined expense management. Tell us about their Fit for Growth program.
Right, the Fit for Growth program. It's a key initiative, really, aiming to simplify, standardize, and digitize the bank's operations. The goal is to generate $1.5 billion in savings.
A significant target.
It is. And what's particularly noteworthy is that while their overall expense cap guidance, that's below about $12.3 billion by 2026, that remains unchanged.
Right.
The phasing of their capital expenditure, the CTA, for 2025 has been revised. It's now expected to be around 45% of the total program spend for the year.
Down from about 50% previously.
Exactly. But they stress this isn't a slowdown. It's more a disciplined approach to make sure these strategic investments truly achieve transformational results, not just throwing money at problems.
Yeah. Got it. Smart spending.
And it seems to be working. Costs, if you exclude FX headwinds and a sort of technical deposit insurance reclassification, were up only 2% year on year in Q2. That shows pretty tight control.
Okay. Shifting gears slightly to the credit side, impairment looked surprisingly subdued at $117 million in Q2, actually benefited from some net recoveries.
Yeah, quite low. But management did say they expect the loan loss rate, the LLR, to eventually normalize, sort of move back towards that 35 basis points range.
So expect that to tick up a bit over time.
Probably, yes. And regarding specific risks, people always ask about Hong Kong commercial real estate, CRE.
Right.
Their exposure there seems notably resilient. It's a relatively small portfolio, high-performing primarily with large, diversified developers, and importantly, very low loan-to-value ratios.
So not a major concern flashing red.
Doesn't look like it. They did see an increase in Stage 2 loans. Those are loans showing increased credit risk since origination, though not necessarily impaired yet.
Oh.
But that was largely due to reclassifying some sovereign debt, which can still be investment grade. So again, not really a red flag for widespread credit deterioration in their core books.
Good context. Moving to how they're managing their capital. You mentioned the buyback and dividend.
Mm-hmm.
That interim dividend increase and the new $1.3 billion share buyback are part of a larger, quite ambitious plan, actually. They aim to return at least $8 billion to shareholders between 2024 and 2026.
At least $8 billion.
And they specifically emphasize that they aim to exceed this target.
Yeah, they put an emphasis on exceed.
Hmm.
In the grand scheme of things, this tells you the company prioritizes investing to grow its business sustainably, aiming for higher returns long-term.
But also returning capital.
Absolutely. While share buybacks are certainly attractive when the stock is trading at a discount to its book value, as it has been,
Right.
management will carefully consider the optimal mix between buybacks and organic investments, especially as the share price gets closer to or maybe even exceeds book value. It's a strategic balancing act.
Makes sense. Yeah. Let's pivot now to what many are calling a cornerstone of their long-term strategy that focus on cross-border and affluent banking. How are these efforts actually translating into tangible gains for the bank?
Well, this strategic focus certainly seems to be paying off. Their network business, which represents a huge chunk, 60% of their corporate and institutional banking income, showed impressive resilience.
Okay.
They saw a 17% increase in income just from intra-Asian corridors. This really highlights their unique geographical strength in those markets.
It's a real advantage there.
Definitely. And in wealth solutions, they attracted a record $16 billion in net new money just in Q2.
$16 billion.
Yeah. And onboarded 64,000 new affluent clients. That brings the year-to-date total to 135,000 new clients.
Huge numbers.
They are. They've now climbed to become the #3 affluent wealth manager in Asia, and they have this really ambitious target to deliver $200 billion of net new money between 2025 and 2029.
$200 billion. That's a big goal.
Yeah.
Now, another area Standard Chartered is clearly making a strong play is digital assets.
Oh.
They view digital assets as an inexorable direction of travel, I think was the quote.
That's the phrase they use.
And they're actively acting as a bridge, it seems, between traditional finance and digital assets for their institutional clients.
Their initiatives here are pretty extensive, actually. You've got Zodia Markets, for example. Its notional trading volume almost tripled year on year.
Told.
Yeah. And it's responsible for over 20% of USDC net minting. That means they facilitate the creation of a significant portion of new USDC stablecoins hitting the market.
So a major player in that stablecoin infrastructure.
Seems like it. Then there's Zodia Custody, their digital asset custody service. It grew assets under custody 10 times in just 18 months.
Tenfold growth. Incredible.
It is. They've also launched trading in deliverable spot Bitcoin and Ether for clients. They've secured a digital asset custody license in Luxembourg for EU clients, and they're part of a joint venture applying for a Hong Kong dollar-backed stablecoin license.
A Hong Kong dollar stablecoin.
Interesting. Very. They aim to be the only Hong Kong node issuing bank that's also an issuer, a very strategic position if they get it.
Now, you mentioned stablecoin licensing. It seems the timeline for HKD and USD stablecoins is now expected in 2026. That's a bit later than maybe some expected.
Yeah, a slight delay compared to maybe initial market hopes. But management sees these ventures as highly strategic for future market share, for efficiency gains, and ultimately for revenue.
Even if they aren't generating huge profits today.
Exactly. They understand they're building for tomorrow's financial infrastructure. It's a long game.
Makes sense. Shifting to another key strategic area, sustainable finance.
Big focus for them.
They seem well on track to achieve their target of at least $1 billion in income from this area by 2025.
They do. They've already mobilized $136 billion since 2021 towards that $300 billion commitment by 2030.
So nearly halfway there on the mobilization target.
Getting there. Highlights include their first $1 billion social bond and participation in key energy transition projects like carbon capture initiatives. This isn't just, talk. It's tangible action in what's clearly a massive growth area globally.
Okay. And how did management frame the broader macro environment? Still lots of uncertainty out there.
True. They acknowledge the uncertainties persist, but interestingly, they feel this actually plays to Standard Chartered strengths.
How so?
Particularly their cross-border capabilities. They observe globalization evolving, not ending, but changing. Clients are diversifying supply chains, often into markets where Stanchart has a really strong, established presence.
Like Southeast Asia, India, Africa.
Exactly. And this naturally benefits their FX business, their financing activities, and their global banking franchise overall. It turns a potential challenge into an opportunity for them.
Right, leaning into their network strength.
Precisely. And to underscore their confidence, their full year 2025 income growth guidance has been upgraded. It's now around the bottom of 5-7% at constant currency, excluding notable items.
Upgraded guidance, okay.
And the 2023-26 income compound annual growth rate, the CAGR, is now tracking towards the upper end of that 5-7% range they previously set out. That shows significant upward momentum in the underlying business.
Okay, so strong results, strategic progress. How did the market react immediately after the call?
Well, the market's reaction was pretty positive overall. Standard Chartered shares opened roughly flat as the call actually began.
Okay.
But they closed the day up a solid 2.1%.
A decent poppin'.
Yeah. And this positive sentiment, even with those NII headwinds we discussed, suggests a strong vote of confidence for investors, I think.
So the immediate query here is, why the positive reaction despite the NII caution?
Well, it seems the broad-based beat across the financials, that higher dividend, the new buyback announcement, and perhaps most importantly, that robust non-NII engine.
Yeah, that 31% jump.
Exactly. That clearly offset the sort of flattish NII picture and any lingering macro caution. The market appears to be rewarding the underlying growth story and the very clear capital return plan. They're seeing beyond the near-term NII challenges.
Makes sense. So for investors listening, what are the near-term catalysts to watch?
Good question. Key things to keep an eye on include the ongoing execution of that $1.3 billion buyback.
Right, see how quickly they deploy that.
Then there's the Q3 trading update, which is expected on October 30th. That will give the next snapshot of performance.
Okay, end of October.
And, of course, continued progress in wealth net new money, watching if they stay on track towards that really ambitious $200 billion target.
Okay, now let's explore some, shall we say, intriguing possibilities. This is the part where we talk about what this could mean for investors, always keeping in mind this isn't financial advice.
Absolutely not financial advice, just exploring ideas.
Right. Given Standard Chartered's aggressive stance on digital assets and the future of finance, combined with that robust capital position and strategic focus, here's a thought for you.
Okay, I'm listening. It's compelling to consider how these strategic moves could translate into genuinely unique market positioning over time.
Exactly. So, trade idea one, the digital bridge builder, long-term view.
Okay.
Consider Standard Chartered as a long-term play. But here's the twist. Pair it with a strategic short position.
The pairs trade.
Yeah. Imagine going long Standard Chartered while simultaneously shorting a traditional, maybe purely domestic, regional bank. One that has shown little to no real innovation or investment in digital asset infrastructure.
A digital laggard.
Precisely. The core idea, the thesis here, is that Standard Chartered's early and deep penetration into institutional digital asset services, Zodia custody, Zodia markets, the stablecoin stuff, direct crypto trading, will create a powerful competitive moat over time. As traditional finance inevitably converges more with digital assets, Standard Chartered could become the preferred bridge for institutional clients globally. They could capture significant market share, significant fee income from services that these undifferentiated domestic players simply cannot offer.
And those laggards face obsolescence or expensive catch-up.
Exactly. They'll either be forced into expensive, delayed catch-up or risk becoming obsolete, while Standard Chartered reaps those first-mover advantages in what they probably rightly see as an inexorable direction of travel.
And the potential ROTE uplift from that
Could be substantial. This new, potentially capital-light, high-volume business, even if fees compress eventually, could significantly uplift their returns, dwarfing those of competitors stuck in a purely analog world.
Stepping back, it's really a bet on that long-term structural shift in finance, isn't it? Where these early movers could potentially dominate.
Yeah.
Not just about the next quarter's result.
Absolutely. Okay, trade idea 2. Emerging markets ESG alpha, the green transition play.
ESG alpha, okay.
Right. This isn't about just general ESG investing. It's about Standard Chartered's very specific and deliberate targeting of sustainable finance, particularly in emerging markets where they have that deep, established network.
Right, leveraging their footprint.
They've already mobilized $136 billion, on track for $300 billion by 2030. We heard concrete examples like the Indonesia Just Energy Transition Partnership solar project.
Tangible projects.
This uniquely positions them, you could argue, to benefit from the massive multi-trillion-dollar capital flows that are going to be directed towards climate transition in these regions.
Huge sums involved there.
Immense. Now, the interesting counterplay here, the short side of the trade, could be a basket of emerging market companies, specifically those heavily reliant on fossil fuel extraction, or maybe energy-intensive, carbon-heavy industries.
Particularly those with weak balance sheets.
Yeah, especially those with high debt loads and, crucially, limited or unclear transition plans.
Okay, I see the logic.
As global capital markets increasingly penalize those kinds of entities and reward the transition leaders, Standard Chartered's financing and advisory role in sustainable projects could provide them with a high-growth, potentially lower-risk revenue stream.
While the shorts face headwinds.
Exactly. The shorts could face stranded asset risks, meaning their assets become less valuable or even worthless due to environmental policies or market shifts alongside an increasing cost of capital. This play really leverages Standard Chartered's unique geography and their stated commitment to a segment that's both critical for the planet and, frankly, underfinanced by many traditional banks.
A key question arising from this, though, is can they maintain this pace and leadership in such a rapidly evolving and competitive space? Sustainable finance is getting crowded. And how quickly will these investments really translate into material bottom-line impact?
Excellent point. Execution risk is always there, and the timing of the payoff is uncertain. Which brings us neatly to our disclaimer.
The important bit.
Disclaimer. These are speculative ideas purely for discussion. They are not actual financial advice. Always conduct your own thorough research and consult with a qualified financial professional before making any investment decisions.
That's right. Investment in financial markets carries inherent risks.
And past performance is certainly not indicative of future results. Okay, wrapping up. Standard Chartered delivered a genuinely strong set of results for H1 2025. They exceeded expectations and demonstrated, I think, excellent progress against their key strategic priorities.
I'd agree. The robust growth in non-interest income, especially from wealth solutions and global markets, alongside that significant commitment to capital returns, really highlights the bank's resilient and forward-looking business model.
Yeah. While we and investors should remain vigilant on the evolving macro landscape and those NII trends,
Definitely keep an eye on NII.
the underlying momentum and those strategic investments in areas like digital assets, affluent banking, and sustainable finance really seem to position Standard Chartered for continued strength. They are actively building for the future.
Seems that way. Thank you for joining us on this deep dive into Standard Chartered's earnings. We're always eager for your insights and questions. Keep the conversation going.
Absolutely. We hope this deep dive provided you with valuable insights into Standard Chartered's performance and strategy. Tune in next time for more in-depth analysis of the stories behind the numbers.